Welcome back to Mind Nudge Finance. Great to have you with us. You're tuning in because, well, you want your money working smarter for you.
Right, that's the goal.
Exactly. So today, we're tackling a really core strategy for that. Building a diversified investment portfolio.
Mm-hmm. It's absolutely fundamental.
We hear that term a lot. It's kind of the bedrock, isn't it? For protecting your investments and actually moving towards those big financial goals.
It really is. Stick with us and you'll get a much clearer picture of how diversification can become, your financial superpower.
Okay, superpower. I like that. So let's maybe start at the beginning. For anyone who's heard diversification but isn't totally sure what it means day to day, what are we actually talking about?
Sure. So in simple terms, it's about spreading your investments, putting them across different types of assets.
The old don't put all your eggs in one basket thing.
That's exactly it. It's the perfect analogy, really, because if one type of investment, say stocks, takes a tumble,
Which happens?
which inevitably happens, yeah, the impact on your entire portfolio is cushioned, it's minimized, because hopefully you've got other things, maybe bonds or real estate, that are behaving differently.
Right, okay, so it's a buffer. It stops one bad apple spoiling the whole bunch, so to speak.
Yeah.
That idea of one sector crashing and wiping me out, yeah, that's not appealing.
Definitely not. And by having that mix, you're essentially building a stronger financial base. It's a key part of working towards, real financial security over the long run.
Okay, so the why is clear. Protection, stability, less panic when the markets get choppy. Let's get practical then. How does someone actually do this? What are the steps to build one?
Right. Well, the very, very first step, before you even think about specific investments, is to get clear on your own situation. Meaning, what are your financial goals? What are you actually investing for? Retirement way down the line, a house deposit in 5 years. The timeline matters.
Yeah.
And just as importantly, you need to be honest about your risk tolerance. How much fluctuation, how much up and down in your portfolio's value can you actually stomach without losing sleep?
That's a big one. So knowing yourself first.
Absolutely. Your answers there really shape the kind of diversification that makes sense for you. Someone young with decades until retirement can generally afford to take on more risk, more potential volatility, than someone nearing retirement who needs more stability.
It makes total sense. Okay, so I've done my homework. I know my goals. I know how much risk feels okay. What's next? How do I choose the mix?
Then you start looking at the main asset classes. The big buckets, you could say.
Like what?
Well, you've got stocks or equities. They generally offer the highest potential for growth over time, but they also come with more volatility, more ups and downs.
Right. High risk, high reward potential.
Kind of, yeah. Then you have bonds. These are essentially loans to governments or companies. They tend to be more stable, providing income, but usually lower long-term growth than stocks.
Okay, stability and income.
Then there's real estate. Tangible assets can provide diversification and potential rental income, though it's less liquid, harder to sell quickly.
Got it.
And finally, cash or cash equivalents. Think savings accounts, money market funds. Very low risk, very liquid, meaning you can access it easily, but low growth potential, often not even keeping pace with inflation. Crucial for emergencies, though.
So it's about blending those different types. It's not just buying like 10 different tech stocks.
Exactly right. That's a common misconception. Diversification needs to happen within asset classes, too.
Absolutely.
So within your stock allocation, for example, you don't just want tech stocks. You'd want to spread it across different sectors: healthcare, finance, energy, consumer goods, you name it.
Oh, okay.
And even different geographies. So U.S. stocks, international stocks, maybe some emerging markets, because different sectors and different countries' economies often move differently in response to, well, whatever's happening in the world.
Right. So if tech takes a hit, maybe healthcare is doing okay, or international markets are up.
Precisely. It adds another layer of that cushioning effect.
Okay. This is making sense, but I could see how it might start to feel complicated.
Yeah.
And potentially expensive, buying all these individual things.
That's a very valid point. And that's exactly where things like low-cost index funds or ETFs, exchange-traded funds, are incredibly useful.
Okay, tell me more about those.
Think of them like ready-made investment baskets. So instead of you having to pick, say, 500 individual stocks.
Which sounds daunting.
It can be. You could buy an S&P 500 index fund or ETF. And just like that, with one purchase, you own a tiny slice of the 500 largest companies in the U.S. spread across all those different sectors we mentioned.
Wow, okay, so instant diversification.
Instant diversification, yeah. And usually at a very low cost compared to actively managed funds or buying tons of individual stocks. It takes a lot of the guesswork and complexity out for the average investor.
That sounds like a game changer, honestly.
Yeah.
Much more accessible. Okay, so let's say I've used ETFs. I've built this nice diversified portfolio. Am I done? Can I just kick back and let it ride?
Not quite. It's not really a set it and forget it kind of deal. Maintaining your portfolio is, it's an ongoing process.
Meaning I have to keep fiddling with it.
Not constantly fiddling, but you do need to review it periodically, maybe once a year. Or if there's a big change in your life, like getting married or changing jobs, or even just significant market shifts.
And what am I looking for when I review it?
You're checking your asset allocation. That's the fancy term for that mix you decided on earlier, say 60% stocks, 40% bonds. You need to see if it's still roughly where you want it to be.
Why would it change if I haven't touched it?
Because different parts of your portfolio will grow at different rates. Let's say stocks have had a fantastic year and bonds have been flat.
Yeah.
Your portfolio might now be, say, 70% stocks and 30% bonds, just because the stocks grew so much. That might be more risk than you originally intended.
Ah, right. It drifts.
Exactly. It drifts. So rebalancing comes in here. That's when you'd sell some of the assets that have done really well, the stocks in this case, and use the money to buy more the ones that haven't, the bonds, to get back to your target 60-40 mix.
Okay, so it's about maintaining that original balance you decided was right for your goals and risk tolerance.
Precisely. And, of course, as your life circumstances change, maybe you're getting closer to retirement and want less risk, you'd proactively adjust that target allocation itself, maybe shifting more towards bonds over time.
Right, makes sense. It evolves with you. Okay, this has been super helpful. Before we wrap up, any sort of final key tips for success for listeners who are thinking, okay, I need to do this, or maybe I need to check on my existing portfolio?
Yeah, definitely. 3 things probably stand out. First, start early. Seriously, the earlier you begin, the better.
Compound interest, right?
Compound interest is magic, truly.
Yeah.
Time is your biggest ally in investing. Even small amounts invested early can grow significantly over decades. Second, stay consistent. Invest regularly. Don't try to time the market. It's incredibly hard, even for professionals. Just commit to investing a certain amount periodically, like every month or quarter, no matter what the market headlines are screaming. It's called dollar cost averaging.
Right. Sometimes you buy high, sometimes low, but it averages out.
It helps smooth out the ride, yeah. And finally, keep learning. Educate yourself. Read. Listen to podcasts like this one. Understand what you're investing in. The more you know, the more confident and informed your decisions will be.
Start early. Be consistent. Keep learning. Fantastic practical advice. So wrapping it all up, the big message seems to be that diversification isn't just some fancy Wall Street tactic.
Not at all.
It's really a fundamental building block for anyone who's serious about managing risk and actually building toward their financial future, whatever that looks like. It's about resilience.
Absolutely. It's about a thoughtful, balanced approach. Understanding that, different investments do different jobs in your portfolio. And a well-diversified strategy just stacks the odds in your favor for reaching those long-term goals.
Well, that brings us towards the end of this deep dive on diversification. We really hope this has cleared things up and maybe given you some actionable steps for your own portfolio.
Yeah, hopefully it's demystified it a bit.
Definitely. And hey, if you have questions or maybe your own tips about diversification that work for you, please share them. Drop them in the comments below. We love hearing from you.
We do.
And if you found this useful, give us a like, a thumbs up. It genuinely helps other people discover Mind Nudge Finance.
And please hit that subscribe button. You won't want to miss our future deep dives. We cover essential personal finance topics designed to help you make smarter money moves.
That's right. And speaking of future topics, next time we're going to tackle mastering your finances. Top 5 personal finance tips everyone should know. That's going to be a really practical one.
Definitely worth tuning in for.
So thanks so much for joining us today on Mind Nudge Finance.
Until next time, take care.